Joining us now is Thomas Carroll, Vice President, Portfolio Strategy at Stifel. Thomas, great to have you at the desk.
Thank you for having me on.
Thanks so much for being here. All right, you've been making the case that mega cap concentration is extreme, that rotation out of AI winners is likely. We are seeing that play out today. Is this the start of it, or is this just the pause in a still powerful trend?
Yeah, I think we had noticed that markets were at 40-year highs of concentration, where 10 stocks made up nearly 50% of the S&P 500 market cap. And so we thought this overall rally, which had been very strong, was very narrow. And so we were expecting a broadening trade. However, broadening sounds good, but when we looked for the past 5 years, broadening actually led to index consolidation. And so it can lead to some weakness, which we're seeing today exactly.
Okay, so what should we expect from here, though, is the bigger question. Is this something that we should be concerned about, or is it healthy?
I think it's a volatility spike. We'd seen a very large schism in the market. I don't think necessarily this is a sign that the AI trade is over, but I do think it is a sign that the market had gotten very narrow, and so we thought that we were going to see this rotation, which was going to kick up volatility, and it was going to lead to massive dispersion in the market and a lot of volatility-driven headlines.
So we'll talk about where that money is rotating, but first, for the long-term investor, is this actually a buying opportunity, or should we just start to expect lower returns from some of the biggest winners, specifically in technology?
Yeah, I don't think I've seen enough of a sell-off yet in the mega caps to come out here and say we should go rotate into them. I do think we still have a very running hot business investment sector. So there's still tons of capital flowing into the AI scarcity space. But I do think a correction is healthy for the market here, and we would expect it to continue over the next quarter.
So no fresh capital in tech right now, but if you're already in it, stay in it?
Yes, I would say, yeah, what we're expecting, we've been saying, is a rotation from mega caps into your equal weight counterparts. So more of your value will catch a bid after some of the mega cap tech growth has done exceptionally well off of the Hormuz conflict resolving.
Okay, so let's dig into this rotation that you've been seeing. You mentioned mid caps, but talk to us more about where the money's actually going and where retail investors should be putting theirs.
Yeah, so if you look at the overall US economy, we've been talking about this idea that GDP growth is really bifurcating. And so we're seeing a very hot business investment sector, but an inflation squeezed consumer. And so we want to be cognizant of where the economy's headed for where we're telling investors to be pivoted to. And so yes, we've seen consumer stock lag, but I think that makes sense given where the economy is. Whereas for me, on a pullback, I would want to allocate more towards the areas that are really benefiting from the AI build-out. So we're looking at industrials, materials, energy. If we see a resolution here, a pullback, we could potentially see a flare-up later in the year, a possible way to get back in there. And I think a healthy pullback in the tech trade would be potential opportunity to get back into it.
We've been hearing more about this broadening, though, into specifically, you mentioned mid caps, but also small caps.
Yes.
So is that where investors should be focused as well? Because if how the economy is doing matters, if the economy isn't doing well, one would assume that small caps might not either. So is that the wrong place to be putting money, or is that where investors should be focused on?
Well, I think the thing that's helping small caps for the first time in really 4 or 5 years is we're actually getting durable earnings growth and earnings momentum. And so we wrote a report today and we said this is a earnings-led market. That is an environment that small caps can actually do well in, even if there is some overall index volatility around just the momentum trade of the AI and where it had been. So we do think small caps could do well in this environment.
Okay, so you mentioned any beneficiaries of the AI trade. So break that down just for us once more, or kind of recap it for us.
Yes.
Industrials, energy.
So I like to think of it as the hard hat parts of the economy, the things that are really about building, the industrial build out of the AI. Anything in that space is really what's interesting to us. And so that would encompass, as I said, industrials, energy, materials I think could do very well. They were actually loser of the Hormuz conflict. Energy as well if we get a pullback there.
Pullback, I mean,
we've
oil's
already had
below
one.
$80,
Exactly.
So what sort of a pullback would it make it look more attractive?
So I actually think that's an interesting point, is that if you look at the energy market, specifically the oil market, What's been interesting to us has been everyone's focused on the front dated contract of the crude. But if you look at the longer term contract, so the December price for where oil is going to be, it hasn't really fallen that much, which is an indication that maybe some of that demand, the inventory we need to rebuild, there is still more demand for oil, which could actually be bullish for energy as well. If the demand, if we get a little bit of resolution of the geopolitical conflict, we'll come back to more of the actual durable energy, because that's an important part of the AI build out.
What areas of the market would you avoid right now?
Yeah, we think anything really that's being squeezed by inflation. I do think once we get past some of the volatility in the NASDAQ, we might see the splintering show back up in the AI trade, but anything consumer oriented, we think that there's a real consumption squeeze, specifically on incomes in the US, the overall K-shaped methodology, and it makes it very difficult for consumer-led companies to pass on price when they're also getting margin compression. So we're seeing earnings weakness there. And so anything related to there, we would be cautious.
So no staples, no consumer discretionary.
Yes.
You mentioned the splintering coming back. What does that mean?
Yeah, so we had noticed this earlier this year. It's actually a pattern that was reminiscent to the last tech bubble that we had in '99, was the final stages of these tech-driven scarcity bull markets is we see the quote-unquote services side, so the AI services companies, so think like your hyperscalers, the people who are doing the spending, the software, they begin to underperform as the spending requirements go up for these companies. But the people that are receiving the CapEx, the beneficiaries, the semiconductors, the tech hardware companies, the ones that we see in the news all the time, they do very, very well. And that's been a trade that's started to occur last year and has really accelerated this year. And so we're seeing a pullback today a bit in that trade, but the demand is still there. The numbers that these companies are talking about spending is only getting larger.
Interestingly enough, though, some of those beaten down software names are actually higher today.
Yes.
So would you bet on software at this point to play catch up, especially if you're looking for value?
Yeah, so software multiples, right, they're back to like 2008 levels, right? The sector has had very, very strong underperformance. But I do think it's somewhat justified if you look at the overall credit risk premiums, the bond market for these companies. There's a real risk being priced in these companies that these business models are basically under siege from AI. And so, yes, I think we can tactically play maybe a balance here or there, but ultimately, I think having a better feel for the overall business model risk for this sector, I don't think we really know how that's going to play out yet.
Okay, so that's not the part of the splinter that you would be putting your money in.
Yeah, I would still
the,
be, like the hard hat part of the economy, right? The build out.
You describe bull markets in your notes as having explosive starts, unexciting middles, and FOMO-driven finales. Where are we right now?
Yeah, well, I think it's pretty clear to us we're in that final stage. We said bull markets do not go quiet into the night. There's this grand finale, like at the fireworks show, where all of a sudden things start just volatility spikes, price goes up, and so you see these momentum-driven rallies. And it was interesting to us that the best part of the bull market is the beginning and the end. So it becomes difficult to time things because right when you think, oh, we're at a top, that's actually the second highest returning period for markets. And so it's very much so a tactical trading market.
So are you saying this is the end of the bull market then?
I don't think we're there yet. I do think we're in the final stages. I think we'll get a resolution at some point, probably in the back half of this year, on the scale of the spend. Are we getting the return on invested capital from the spend that we're doing? But I think until we really get a sign from the hyperscalers that, hey, maybe there's not the returns on investment that we thought here, I think that will likely continue.
So the final stages could be years?
Well, I would say no. I think the final stage is probably over the next 12 months. I think we will have a more durable answer on just given the sheer size of the spending, if they can sustain it. Because now they've burned through their cash flow. They have to go to equity markets and bond markets to capital raise to be able to sustain the spending, which is really where things get more treacherous.
So it's not time for investors to turn cautious yet, or what should they be doing to potentially prepare themselves for the final stage of the bull market if this is it?
Well, I think we need to be aware with eyes wide open of the risks. As I said earlier, we were expecting this volatility-driven rotation, right? What we are seeing today is very much so what we were expecting from markets. The question becomes is this the end of the bubble, right? Everybody wants to time it. We think the things to look for are really the hyperscaler spending, the guidance, is there signs that that momentum's peaking out yet? We don't think that's happened yet. And so that would be really the sign where all of a sudden I would be thinking, oh my gosh, the market could really fall. We think it'll just be a period of chop. And so if you would like to hedge, we call it defensive value. There are some sectors there that do well when the market goes under these periods of volatility. But we still like the cyclical value space.
And I should note that your S&P 500 price target was just raised to 7,800. So this is a market that you think is ultimately heading higher. It just might not be a straight line to get there.
So we were expecting some near-term weakness in the third quarter. We had become very one-sided on this trade. And so at times, when we see these dispersion widenings, these corrections happen. And so they present buying opportunities. What's really driving this market now is it's an earnings-driven rally, and the earnings still look good to us, and so that's really where we're focusing. It's not, we've been saying we thought multiples were going to come down for some time, which they have, but the earnings have been so strong.
What's the bigger mistake here? Chasing the winners or sitting in cash waiting for an even bigger pullback?
Yeah, well, as I said, the final stage of the bull market is the second best returning period. Right? So if you are sitting there waiting for a top, you might actually miss out on one of the most lucrative times for these bull markets. So especially at the same time where inflation is actually very high, especially relative to money market rates. So if you sit in cash, you might actually underperform just inflation, so it's not really an answer. So we prefer rotating within the market. And so for us, the best way to play this in the shorter term is to look at more of your equal weight indices and then look for a better opportunity to get back into the mega caps, because we do think we are just seeing the start of a pullback.
Okay. And I guess maybe reset your expectations in terms of what sort of returns you could see if leadership is coming from areas other than the most powerful areas of the market right now.
Well, it's, I think, been 3 years you've had almost 20% gains year over year over year. It seems very easy, but as my boss would always say, or my former boss would always say, Barry Bannister, who's very famous, it's like, this game's not easy. Markets are made, as soon as you get confident, they come in and hammer you right there. So we have our eyes wide open on these trades. So.
Okay, I think this is a great time to pivot to our rapid fire game of this
let's do
or that. Quick questions, quick answers. Are you ready?
Yes.
All right, here we go. Markets right now, resilient or fragile?
Fragile.
Economy, running hot or cooling off?
Running hot.
Valuations today, stretched or justified?
Both, I would say. It's a cop-out, but.
Where are they stretched? Where are they justified?
Well, the overall multiple is very elevated, but it is somewhat understandable given where interest rates, I guess, have been. Credit markets are still very tight in terms of risks are low, and also margins are very high. So they're expensive, but I don't think that's necessarily a recipe to see all of a sudden stocks come down because of it.
Okay, important context there. AI, healthy leadership or excessive concentration?
Excessive concentration.
Next leg of the bull market, AI winners or everything else?
Everything else.
Value or growth from here?
Value.
One sector you'd bet on for the rest of the year?
Good question. I think industrials and materials, I know that's two.
One you'd avoid?
Consumer discretionary.
More upside, small caps or large caps?
Small caps in the near term.
Small caps or mid caps?
Small caps.
More likely by year end, new highs or a 10% correction?
I think a 10% correction could occur quickly.
Markets by year end, higher or lower from here?
Higher. I think we get a V.
What's your price target?
We are at 7,800.
One word to describe how you're feeling about the market for the rest of this year.
Nervous.
We'll leave it there. Thank you so much. That's Thomas Carroll, Vice President Portfolio Strategy at Stifel. If you enjoyed this Street Talk, check out our full interview with Keith Lerner. He shares why tech is actually due for a rest and where leadership goes next.